All right, let's dive into Forex trading in 2025. We're unpacking top Forex trading tips for beginners to succeed in 2025. Fresh off the press from Tech Guide this month, we're talking practical tips, not textbook theory, to help you navigate Forex.
And it's a hot topic for good reason.
Oh, absolutely.
Think about it, a global market, open 245 trillions changing hands daily. You, even as a beginner, can tap into that, with the right knowledge, of course.
Right, and the article jumps right into that. Education first, trading second. You can't just jump in. It throws around terms like lot sizes, pips,
Oh, yeah.
currency pairings. To someone new, it's overwhelming. I know it was for me.
It's like assembling furniture without the instructions. Total chaos. You need to learn the language of the market first.
Exactly. So break it down for us. What are those key building blocks explained simply, even if I've never traded a dollar in my life?
Okay, so lot size is basically your quantity. How much currency are you buying or selling? Like, are you buying one apple or a whole bag?
Okay, that makes sense.
Then you've got pips, those tiny price movements like the cents in a dollar, but for currencies. And currency pairings, that's just what's being exchanged, like the euro and the US dollar a pair.
Got it. Lot size, pips, pairings. Okay, feeling a bit more fluent already. So once you've got the lingo down, the article stresses finding the right broker. Seems pretty crucial.
Oh, it is. Your broker's your gateway to the market. You need a reputable one, vital for security, access to the right tools. They're your Forex Sherpa, guiding you through the mountains, so to speak.
I love that.
The article talks about charting tools, which are like your map, showing you the price history, and indicators, which are kind of like signals, using math to point out potential buys or sells.
Yeah, that makes sense. I actually know someone who picked a broker based on a flashy website alone. Ended up losing a lot. Platform was unreliable. Broker was totally unregulated.
Oof. Yeah, that's a painful lesson, but unfortunately a common one. Due diligence is key. You got to look for brokers regulated by solid authorities like the FCA or ASIC. Transparency is key too. Fees need to be clear, those commissions and spreads. And, pro tip, use a demo account first.
This demo account, yeah. Like practicing your golf swing on a simulator before hitting the real course.
Exactly. Risk-free learning. Test your strategies, see how you react under pressure. But remember, virtual money versus real money. Totally different emotional responses. There's a whole psychology to trading.
Right, so even if I'm a demo account superstar, there's no guarantee I'll act the same way when real money's on the line.
That's it. We all make different choices under pressure. Think about those impulse purchases you make and regret later. That happens in trading too. This is why the article's so big on having a trading plan. It's your roadmap, helps you navigate through those emotional ups and downs.
Speaking of roadmaps, the article says a trading plan's key for focus. Like you wouldn't go on a cross-country road trip with that one.
Definitely not, or you'd end up lost. A trading plan outlines your goals, risk tolerance when you enter and exit trades. No plan, and it's easy to get caught up in the moment and make some bad decisions.
And to stay safe, the article's all about risk management. It says, never risk more than 1 or 2% of your capital on a single trade. Sounds simple, but I bet it's tough to stick to.
You'd be surprised how many traders, even experienced ones, get tempted. I remember early in my career, I got a bit too confident after a winning streak and went all in.
Ooh, this is going to be good. What happened?
Well, let's just say the market humbled me real quick. It doesn't care about your ego or your streak. Wiped out a big chunk of my profits that day.
Ouch. Yeah, that's gotta hurt. But I guess a valuable lesson learned. So instead of going all in, the article stresses those stop-loss orders. Can you remind us what those are all about?
Absolutely. A stop loss is an instruction you give your broker. It automatically closes the trade if the price moves against you by a certain amount. It's your safety net.
So it's not about avoiding losses completely. That's probably impossible.
Yeah, pretty much, yeah.
But it's about limiting them.
Exactly, managing the downside. Like if you're rock climbing, you use a rope to prevent a big fall, not to stop you from climbing higher. Same idea.
That's a great way to put it. Now, the article's also big on starting small. It seems counterintuitive, right? You want to jump in, make those big profits.
I know, right? But think of it like learning a new language. You don't become fluent overnight. Start small, gain experience, build confidence, then you can handle the complex stuff. Same with trading.
Like leveling up in a video game.
Yeah.
You wouldn't face the final boss without gaining experience and skills along the way.
Exactly. And speaking of things that can amplify gains and losses, there's leverage.
Leverage, that's a word I've heard thrown around, but I'm not sure I totally get it.
Think of it as a tool that magnifies your buying power. You have $1,000, but with leverage, you can control, say, $10,000. Like using a lever to lift a heavy object.
Okay, that makes sense. But the article warns against high leverage, especially for beginners. It's like being handed a Ferrari when you've only driven a go-kart. Could be exciting, but also disastrous.
Perfect analogy. High leverage, it can boost your profits, yeah, but it multiplies your losses too, and fast. So many stories of traders wiping out their accounts because they misused leverage. It's a tool that demands respect.
Not to be taken lightly.
No, not at all.
So it's about finding that balance, maximizing potential, but keeping the risk in check.
Right, exactly. And that brings us to setting realistic goals, something a lot of new traders get tripped up on.
Yeah, it's easy to get caught up in the get-rich-quick fantasy. We see those flashy ads and think, oh, cocktails on a beach next week.
Yeah, it's a trap. The reality is, Forex trading, it's a skill like any other. It takes time, effort, willingness to learn from mistakes. Realistic goals are key. You'll be more grounded, avoid impulsive decisions fueled by, well, greed or fear.
So it's about that consistent, sustainable growth, building that solid foundation. It's a marathon, not a sprint, right?
Precisely. Now, the article talks about staying updated on market news. Makes sense, right? Like checking the weather before a hike.
Yeah, you want to know what you're getting into?
Exactly. Currency prices fluctuate based on so many things: economic data, geopolitical events, even natural disasters. You got to stay informed to make good trading decisions.
They mention economic calendars and financial news websites.
Right.
Any you'd recommend for someone starting out?
So many great resources out there, but I'd say start with the reputable financial news outlets. Bloomberg, Reuters, Financial Times, they cover it all, global events and how they affect the markets.
I find having a news app on my phone really helpful, keeps me in the loop.
Great tip. Technology makes it so easy to stay connected. Speaking of technology, let's move on to technical analysis. I know this part can seem intimidating to beginners.
It does.
Yeah.
This is where it starts to feel like rocket science, right?
Yeah.
The article mentions candlestick charts, moving averages, RSI.
Oh yeah, those are key.
They sound like code words.
I get why it feels overwhelming, but think of technical analysis as learning to read the charts, a new language. It's about spotting patterns and signals, trying to anticipate where the price might go next.
So less about predicting the future, more about understanding the past to inform your present decisions.
Exactly, like a financial detective looking for clues. I like that.
I like that too. So, candlestick charts. The article mentions those as a good starting point. Can you give us a quick breakdown?
They're a visual way to see price action over time. They show the opening, closing, high, and low prices, all in a single candlestick, like a mini story of what happened to the price.
Interesting. So it's more than just a line on a graph. You get that full picture.
You do. You see its journey, the struggles, the triumphs, and by learning to read those patterns, you can spot potential buy and sell opportunities.
Got it. Now, the article also mentions moving averages. What are those?
Think of it as smoothing out the price fluctuations so you can see the trend more clearly, like using a map that highlights the main roads and filters out all the small side streets.
So if the price is above the moving average, it suggests an uptrend, and below, a downtrend.
You got it. That's the basic idea. It can get more complex, but that's a good starting point. They help you spot trends and those support and resistance levels.
Support and resistance, those sound important, but what are they exactly?
Imagine support as the floor and resistance as the ceiling for the price.
Okay.
Support's where there's enough buying to prevent further falls, and resistance is where selling kicks in to stop it rising further.
Got it. So if the price is nearing support, maybe it's a good time to consider buying. And if it's near resistance, maybe time to sell.
Exactly. Simplified, but you're getting the idea.
Wow, this is making me realize Forex is more than just guessing if a currency will go up or down.
Oh, so much more. There's analysis, strategy. We've only just begun to explore it. We've looked at technical analysis, but there's another side.
You're talking about fundamental analysis, right? Getting the bigger picture, the forces driving the markets.
You got it. It's about looking beyond the charts, examining the economic and political factors that can move those currency prices. It's like understanding the car's engine, not just how fast the wheels are spinning.
Right. So we're digging into things like interest rates, GDP, inflation, even political stability, all those real-world things that can impact a country's economy and its currency.
Exactly. Let's say a country raises its interest rates. That can attract investors, more demand for their currency, and its value goes up. On the other hand, political turmoil, economic instability, that can make a currency less attractive.
Wow. So we're connecting the dots between real-world events and their impact on currencies.
Precisely. And while they seem separate, technical and fundamental analysis can actually work really well together. You get a much more complete view of the market.
Like having different lenses to look through, getting multiple perspectives.
Exactly. Now, let's move on to one of the most fascinating and often overlooked aspects of Forex, the psychology of it all.
This is where it gets interesting. It's not just numbers on a chart. It's understanding our own emotions and how they can drive decisions, sometimes bad ones.
You got it. Emotions, they can be our greatest asset and our worst enemy. They can fuel our passion, keep us focused, but they can also cloud our judgment, lead to impulsive moves that hurt our bottom line.
So it's about recognizing those emotional pitfalls and figuring out how to avoid them.
Right. The article talks about overtrading, that urge to be in the market all the time, even when there's no clear opportunity.
Like when you're on a winning streak at the casino and think you can't lose, but the house always wins in the end.
Perfect analogy.
Mm.
In Forex, just like gambling, overtrading can lead to impulsive decisions, higher costs, and ultimately, you guessed it, bigger losses.
So how do we avoid that?
Discipline, discipline, discipline. Set trading limits, both the number of trades and how much you risk. Stay grounded, avoid those emotional impulses.
Like setting boundaries for ourselves, right?
Yeah.
Those guardrails to keep us on track.
Precisely. And another powerful tool is a trading journal. Think of it like a therapist for your trading mindset.
Now, I've heard about trading journals, but I've never really understood them. It's more than just writing down your wins and losses, right?
Way more than that. A trading journal helps you track your progress, sure, but also spot your strengths and weaknesses, analyze your decisions. It's about understanding yourself as a trader, how your emotions play into it.
So you're not just recording the trade itself, you're capturing your feelings, your thoughts at that moment. What led you to that decision?
Exactly. And by doing that, you start to see patterns. Maybe you notice you make impulsive trades when you're stressed or overly confident, or maybe your best trades happen when you stick to a certain pattern you've been studying.
It's like bringing those hidden tendencies to the surface so we can actually see them.
Exactly. And once you see them, you can address them and become a more disciplined and rational trader.
Makes sense. And the article is big on controlling emotions. It's like being a Jedi master, using the Force to stay calm and focused amidst all the market chaos.
Love that image. And it's so true. You need those emotional regulation skills. Fear and greed, they're powerful forces in trading and can lead to bad decisions that we regret later.
Yeah, I can see that. Fear makes you hesitate, maybe miss an opportunity, and greed pushes you to take too much risk.
Absolutely. The key is finding ways to manage those emotions so they don't control your trading.
The article mentions things like mindfulness, breathing exercises. It's about having those mental tools to stay grounded, even when the market's going crazy.
Those are great techniques, and there are many others out there. It's about finding what works for you, building a routine to stay calm, focused, and in control.
I remember one time I made a terrible trade based purely on emotion. Was feeling frustrated after some losses and decided to double down on a trade that was clearly going against me. Revenge trading, they call it. And it cost me big time.
Yeah, I've been there. We all have. It's those moments when you're vulnerable. That's when you need a plan, a strategy, and those tools to manage those emotions.
Like a safety net for your mind, Chuck.
Yeah, you got it. And the more you practice, the better you get at recognizing those triggers and responding in a way that actually helps you instead of hurting you. Now, let's shift gears a bit and talk about some more advanced techniques that can really level up your trading game.
I'm ready. What's next?
Let's revisit technical analysis and look at some more sophisticated tools and strategies to help you spot those hidden patterns in the market.
Take me deeper into the matrix.
Okay, so let's talk indicators. We touched on moving averages, but there's a whole universe out there. Each indicator measures something different, like price action or market momentum.
I've seen those trading platforms where the charts are covered in indicators. It's like a plate of spaghetti.
Yeah, it can be overwhelming. You don't need to use them all. The trick is finding a few that work for you, that help you see the market more clearly.
Find the ones that speak your language, so to speak.
Exactly. One that's often overlooked but really powerful when used right is the Relative Strength Index, or RSI.
I've heard of RSI, but I don't really know what it tells us about the market.
It basically measures how quickly the price is moving. Think of it like a thermometer for the market. Is it hot or is it cold?
Okay, so a high RSI means the market might be overbought, like it's gone up too far too fast. A low RSI means it might be oversold, gone down too much too quickly.
You got it. It helps you spot those potential turning points in the market.
Fascinating. The article also mentioned something called Fibonacci retracements. Sounds a bit mystical.
It does sound like that, but it's based on math, a sequence discovered by Fibonacci, this 13th century Italian mathematician.
Okay, now I'm really intrigued. How do these Fibonacci retracements relate to trading?
They're horizontal lines that show areas of support and resistance based on these key Fibonacci ratios. Think 23.6%, 38.2%, those kinds of numbers. They can help you identify potential reversal points.
So if a currency pair is trending up and then starts to pull back, you might look for support at one of those Fibonacci levels, hoping buyers will step in and push it back up.
Exactly. They work well with other indicators like moving averages and RSI to confirm potential trading signals.
This is amazing. There's a whole world of hidden patterns and mathematical relationships within the market.
There is. That's what makes technical analysis so rewarding. It's using logic, observation, and even creativity to unlock the market's secrets.
Makes you realize Forex trading is a lot more than just a game of chance. It's about deep understanding, mastering tools, and honing your skills.
Exactly. It's a constant journey of learning and discovery. The more you put into it, the more rewarding it can be. And don't forget about fundamental analysis, looking at the bigger picture.
Right. We touched on it briefly, but it deserves a deeper look.
It does. It's about those economic and political forces shaping the markets, like having a backstage pass to the global economic theater.
I love that image. So instead of just watching the actors on stage, we're getting a glimpse of what's happening behind the scenes, the directors, producers, scriptwriters, all those forces that are influencing the show.
That's a fantastic way to put it. By understanding those forces, you can try to anticipate those market shifts and position yourself accordingly.
So let's pull back the curtain. What are some of those key factors we should be paying attention to?
One of the most important is interest rates. Central banks, they set those rates, and they had a huge impact on currency values.
Right. We talked about that before. Higher rates attract investors, push demand up, and the currency's value likely goes up too. Lower rates can do the opposite.
Exactly. And it's not just about the current rate, it's about expectations for future rate changes. The market tries to anticipate those moves. Understanding central bank policy is crucial.
So we're not just reacting to what's already happened. We're trying to see what might happen next.
You got it. And economic growth, usually measured by GDP, is key too. A strong economy attracts investment, strengthens the currency.
Makes sense. And if the economy is struggling, the currency might weaken.
That's right. And it's not just GDP, it's looking at a range of economic indicators. Inflation, unemployment, consumer confidence, manufacturing activity, they all paint a picture of how healthy an economy is and how that might impact its currency.
It's like we're taking the pulse of the economy, checking its vital signs.
Perfect analogy. And don't forget those political factors. Stability, government policies, geopolitical events, all can have big impacts on currency markets.
Oh, yeah. Elections, trade wars, conflicts, all those things create volatility and uncertainty.
Absolutely. Staying informed is key to anticipating potential shifts in those currency values.
So fundamental analysis is really about connecting the dots, understanding those big forces shaping the markets.
You got it. And when you combine those fundamental insights with your technical analysis, you have a really well-rounded approach. You're considering the big picture and those little details of price action, too.
It's like having both binoculars and a microscope. Zoom in, zoom out, multiple perspectives.
Great way to put it. And by mastering both tools, you can navigate the complexity of the Forex market with more clarity and confidence.
Now, as we're exploring all this, I keep thinking about technology's impact on trading. It's changing everything.
Absolutely. Technology is revolutionizing how we trade Forex, everything from the platforms to the tools, even the strategies.
I'm really curious about automation, those trading bots. The article touches on it, but I think there's more to unpack there.
You're right. The rise of trading bots is fascinating. It's really changing the landscape.
For those who might not be familiar, can you explain what a trading bot is and how it works?
Imagine a piece of software that executes trades for you 24/7 based on your predefined rules. That's essentially what a trading bot is.
So it's like a personal trading assistant working even while you sleep.
Exactly. And that's the appeal, especially for people with limited time or who want to remove emotions from their trading.
It takes the human element out of it, which can be good and bad, right?
It can. A bot can execute trades with speed and precision that we humans can only dream of. No fear, no greed, no impulsive moves.
But it can only operate within those parameters that you set. It can adapt to those unexpected events or make those intuitive decisions that sometimes lead to those big wins.
That's the trade-off. You gain consistency, efficiency, but lose some flexibility, some creativity.
So are trading bots for everyone? or just certain types of traders?
That's tough to answer. It depends on your trading style, how much risk you're comfortable with, your technical skills, how comfortable you are with technology in general.
A scalper, someone who's in and out of trades quickly, they might love a bot,
Yeah.
but a position trader, someone who holds trades for longer periods, they might prefer a more hands-on approach.
Exactly. And you got to remember, trading bots are not a magic bullet. You still have to set them up, monitor them, adjust them. They're not just a set it and forget it solution.
Right, you got to understand how they work, what they're doing, what the risks are.
You do. And I think it's smart to approach them with a bit of skepticism. Don't just follow the hype. Do your research, understand the potential ups and downs, make sure they fit your goals.
Like any tool, in the right hands they're powerful, but in the wrong hands, well, they can do more harm than good.
Great way to put it. It's a reminder that technology, it's powerful, but it's only as good as the person using it.
So it's not about replacing us with robots. It's about finding ways to use technology to improve our own skills and make smarter decisions.
Exactly. And as technology keeps improving, we'll see even more tools and strategies appear in the world of Forex trading.
It's an exciting time to be a Forex trader. With the right knowledge, the right tools, and the right mindset, the possibilities are endless.
They are. And with that, I think it's a good place to pause for now.
We'll pick up right where we left off in part 2. We've laid a great foundation, explored some tools and strategies. Now we're ready to tackle those more advanced concepts and those tricky psychological elements that can really make or break your success in Forex.
Looking forward to it.
Welcome back to our Forex journey. Last time we tackled the basics, those key terms, finding the right broker, and we even touched on the mental game of trading.
Right. We laid the groundwork for analyzing the market, both technically looking at those charts and patterns, and fundamentally those big economic forces.
So much to learn. Today, let's go beyond the basics. What are some of those advanced techniques that can really up our game?
One thing that separates the pros is their ability to blend different analysis approaches. We talked about technical and fundamental analysis separately, but the real magic is combining them.
Instead of two separate toolboxes, it's like they're complementary, used together to get a more complete picture.
Exactly. Say you spot a potential trade based on a pattern on a chart.
Like a breakout from a key resistance level, that could mean a change in momentum.
Right. But before jumping in, you dig into those fundamentals. What's the economic outlook for those currencies? Any news coming out, central bank announcements, anything that could shake things up?
So you're using fundamentals to double-check those technical signals, like getting a second opinion before a big decision.
Perfect analogy. This multi-layered approach helps you filter out the noise and find those high-probability trades.
Smart. Now, the article mentions backtesting, which sounds interesting.
Backtesting is crucial when you're developing a strategy. It's basically testing it on historical data to see how it would have performed in the past.
So instead of relying on gut feeling, you're putting it to the test, using real market data to see if it actually holds up.
Exactly. It's like a pilot using a flight simulator to practice different situations before flying a real plane.
A dress rehearsal for your trading strategy. Find the weak spots. Make adjustments before risking real money.
Right. And these days, backtesting is easier than ever. There are tons of programs and platforms out there that let you test your strategies on years of data.
Like a time machine for your trading. You can see how your strategy would handle different market conditions.
Love that. And by analyzing those results, you can tweak your entry and exit points, adjust your risk management, and create a more solid system.
We talked about trading bots earlier. Can backtesting be used to check how effective a bot is?
Absolutely. Backtesting is essential when developing and fine-tuning a bot. You feed it historical data, see how it would have performed, and you can spot any weaknesses, adjust the settings.
It's like putting it through boot camp. Make sure it can handle the pressure.
Exactly. But remember, even the best bot can't predict the future perfectly. Markets change, unexpected things happen.
Right, it's not about getting rich quick. It's about using technology to improve your skills, maybe automate some tasks, and manage risk better.
Couldn't have said it better myself. Now, speaking of managing risk, let's talk about position sizing, a concept that's often overlooked, but super important for long-term success.
Position sizing, what's that?
It's about how much capital you put into each trade. Essentially, how much are you willing to risk on any single trade based on your account size and how much risk you're comfortable with?
So it's not just about buying or selling. It's about deciding how much to buy or sell.
You got it. A lot of traders make the mistake of risking too much on one trade.
Like putting your whole life savings on a single hand of poker? You might win big, but losing could be devastating.
That's the point. Position sizing is all about protecting yourself, making sure you can keep trading even if you hit a rough patch.
So how do you determine the right position size for a trade? Any guidelines or formulas to use?
There are a few different approaches, and the best one depends on your personal risk tolerance and trading style. One common method is the fixed percentage risk model.
Okay, tell me more about that.
Basically, you decide on a fixed percentage of your account that you're willing to risk on any single trade, say 1%. So if you have a $10,000 account, you'd risk no more than $100 on a trade.
Okay, I'm following so far.
And then you calculate your position size based on where you set your stop loss.
Right, that stop-loss order we talked about, to automatically close the trade if it goes against you.
Exactly. Let's say your stop loss is 50 pips away from your entry point. To risk no more than $100, you'd adjust your position size accordingly.
There's definitely some math involved, but I see the logic. By limiting your risk to a percentage of your account on each trade, you're creating a cushion.
Right, that's what separates those who stay in the game from those who blow up their accounts.
Speaking of staying disciplined, let's talk about that trading journal again. I'm starting to see how important it is for tracking progress, spotting those good and bad habits, and analyzing decisions.
It's such a valuable tool for self-improvement. It's like a mirror reflecting your trading decisions back at you, good and bad. It helps you see those patterns that might be holding you back.
It's more than just numbers, though. It's about the emotional side, too, right? How were you feeling? What were you thinking? What led you to make that trade?
Exactly. Capture those details and you'll see how your emotions are affecting your trading. Maybe you notice you make impulsive trades when you're stressed or overly confident, or maybe you hang on to losing trades for too long hoping they'll turn around.
It's like uncovering those hidden tendencies that can really sabotage us.
That's it. And once you see them, you can start working on them, becoming a more disciplined and rational trader.
And analyzing the journal, that must be pretty eye-opening. It's like having a coaching session with your own inner trading mentor.
I like that. Regularly reviewing your journal, you can spot those recurring patterns, both good and bad, and then adjust your approach. You might find that certain setups are consistently profitable for you, while others just lead to losses. Maybe you realize you make better decisions when you stick to your plan, avoid those emotional, impulsive trades.
It's a continuous process of improvement, like an artist refining their craft.
Beautiful analogy. That's what makes trading so fascinating. It's a journey of continuous learning and self-discovery.
Before we move on, I want to touch on something else that often gets missed in the excitement of making money: developing a healthy trading mindset.
That's so important. Success in anything, especially trading, is as much about mental toughness as it is about skills.
It's about discipline, patience, resilience, the ability to bounce back after a setback.
You nailed it. Trading is a marathon, not a sprint. There will be ups and downs, wins and losses. Staying focused on the long game, managing your emotions, avoiding impulsive moves fueled by fear or greed, that's key.
Easy to get caught up in the excitement of a win or the frustration of a loss. But a healthy mindset means detachment, seeing each trade as just one piece of data.
Exactly. Take the emotion out of it. Approach it with a clear head.
It's about finding that balance, being passionate but detached, excited but objective, disciplined but flexible.
Perfectly said. That's how traders weather those storms and come out stronger on the other side.
Now, I'm curious about finding a trading community or a mentor. Can that really make a difference?
Oh, absolutely. Trading can be lonely, but having a supportive community, a mentor to guide you, especially when you're new, can be huge.
It's like having a tribe of people who get it, who understand the challenges and rewards, people you can learn from, get support from.
That's it. And a mentor can give you personalized advice, share their experience, help you avoid those common mistakes.
Like a Sherpa guiding you up the mountain, helping you navigate those tricky spots.
I love that. Now let's look at another advanced technique: sentiment analysis.
Sentiment analysis. That's new to me. What's that all about?
It's basically figuring out the overall mood of the market, what people are thinking and feeling about a particular currency pair. It's like understanding the psychology of the crowd and how that can affect prices.
So we're going beyond charts and data, trying to tap into that collective consciousness, those emotions and beliefs that are driving trading decisions.
You got it. Think of it this way. If everyone believes a currency is going up, that belief can become a self-fulfilling prophecy, pushing the price higher.
A snowball effect, where positive sentiment builds and builds.
Exactly. And the opposite is true too. If the sentiment turns negative, that fear and doubt can trigger selling, pushing the price down.
So how do we measure this sentiment? Any tools for that?
There are a few ways. One is to analyze news headlines, social media posts, see if people are optimistic or pessimistic about a certain currency.
So this is where those social media skills come in handy. Scrolling through Twitter, checking blogs and forums, looking for clues.
Exactly. And there are technical tools too, like sentiment indicators that track the ratio of buy orders to sell orders.
So combining those observations from news and social media with those technical indicators, we can get a better understanding of what the market is feeling as a whole.
Precisely. And that understanding can give you an edge, help you anticipate those shifts in sentiment, and position yourself accordingly.
It makes me think about what we discussed earlier about the impact of social media on trading. Those two ideas seem connected.
Absolutely. Social media is a powerful force, influencing sentiment, shaping opinions, even driving prices in real time.
Crazy to think how a single tweet or a viral trend can impact the currency markets.
It's amazing, right? Shows how interconnected everything is. Information spreads so fast, and those online conversations have real-world consequences.
So for a trader, it's not just about charts and data. It's about paying attention to social media, those shifts in the conversation that might signal a change in sentiment.
Right. Social media can be a valuable tool for understanding sentiment, spotting opportunities, even managing risk.
But it's a double-edged sword. It's also a source of misinformation, hype, and manipulation.
You always have to be cautious. Verify information, don't trust everything you see, be wary of those promising unrealistic returns or spreading rumors.
It's about developing a critical eye, filtering out the noise, finding the real insights.
That's a critical skill for any trader, especially these days when there's so much information flying around.
So social media can be a powerful tool for sure, but use it wisely and be skeptical.
I couldn't agree more. And that brings us to another essential aspect of trading, developing a personalized trading plan.
We mentioned it before, but I think it deserves a deeper look, especially after seeing how complex the market can be.
You're right. A trading plan is your roadmap. It helps you make decisions, keeps you focused on your goals, and stops you from going off track when emotions run high.
It's like having a set of rules, a personal constitution for your trading.
I like that. A good trading plan covers several things: your trading style, your risk tolerance, profit targets, time commitment, and your overall goals.
So it's not a one-size-fits-all thing. It's tailored to you, reflecting your individual needs and what you're hoping to achieve.
Exactly. Be honest with yourself about your strengths, weaknesses, how much risk you can handle, how much time you have.
Someone with a full-time job who can only trade a few hours a week might choose swing trading, holding trades for days or even weeks. But someone with more time and a taste for fast-paced action might prefer scalping.
Perfect examples. Your plan should also cover risk management, your position sizing, your stop-loss placement, and your overall risk tolerance.
This is where those risk management principles we discussed come into play, right? Setting boundaries to protect your capital and stay in the game.
Exactly. And it should include your profit targets, your exit strategy.
This is where we define what success looks like, making sure we take profits when we reach our goals and avoid getting emotionally attached to those losing trades.
You got it. Your trading plan should be a living document, something you review and adjust as you gain experience, learn from your mistakes, and grow as a trader.
So it's not a rigid set of rules, it's a framework that guides your decisions while allowing for flexibility.
Exactly. Creating and refining your trading plan is a valuable learning experience. It forces you to think critically about your approach, your strengths and weaknesses, what you want to achieve.
It's a journey of self-discovery, figuring out who you are as a trader and developing a strategy that reflects that.
That's a great way to put it. Embrace that journey, and you'll be well on your way to mastering the art and science of Forex trading.
We've covered so much today. We've explored those more advanced techniques like blending technical and fundamental analysis, back-testing our strategies, and understanding market sentiment. We've also delved deeper into risk management, keeping a trading journal, and building that personalized trading plan.
Right, and we've highlighted how important a healthy trading mindset is, focusing on discipline, patience, resilience, and never stopping learning.
It's clear that being successful in Forex isn't just about the technical stuff. It's about a holistic approach, combining the mental, emotional, and strategic elements.
Well said. And that leads perfectly into our final part, where we'll look at emerging trends, address some common misconceptions, and give you those essential tools and resources to help you on your Forex journey.
So join us for part 3, where we'll wrap up our exploration of the exciting world of Forex trading. Welcome back for the final leg of our Forex deep dive. We've covered those fundamentals, explored some advanced techniques, and even tackled the mental game of trading.
We've built a solid foundation, giving you those tools to analyze the market, manage your risk, create your own plan.
It's been a journey. Now let's look ahead. What's on the horizon for Forex? What trends are emerging?
One big one is AI, artificial intelligence, and machine learning becoming more integrated into trading platforms. We talked about bots, but AI goes beyond just automating things.
So it's not just following preset rules. AI can actually analyze huge amounts of data, find those complex patterns, and make decisions that we humans might miss.
That's it. AI can process news, social media, economic data, all sorts of things, and find insights that would take us forever to uncover.
It's like having a superpowered research team working for you 24/7.
I like that. And as AI gets even smarter, we're going to see even more powerful tools and strategies, which could change the game for everyone.
It's incredible to think about. And speaking of tech changing things, what about mobile trading? Seems like everyone's on their phones these days. Is Forex keeping up?
Oh, absolutely. Mobile trading's exploded in popularity. Traders can monitor the markets, make trades, manage their accounts from anywhere.
It's like having your trading desk in your pocket. You can trade from literally anywhere.
Exactly. And that's opened up Forex to so many more people. Anyone with an internet connection can get involved.
It's making finance more accessible, which is great.
It is. And I think that trend's only going to continue. Those lines between professional and everyday traders are blurring.
Now, before we wrap up, I want to tackle some of those myths about Forex that I think scare a lot of beginners away.
Good idea. It's important to separate fact from fiction, especially in a market like this.
One I hear all the time is that you have to be rich to trade Forex.
That's just not true. We talked about this before. You can start small, especially with micro lots and demo accounts.
And with the right knowledge and a good strategy, even a small account can grow.
Exactly. It's not about how much you have. It's about making smart choices and always being willing to learn.
Another myth is that Forex is a get-rich-quick scheme.
Oh, yeah, that's a dangerous one. Forex is like any investment, there's risk, no guarantees.
It's about building that knowledge, having discipline, managing your risk well. It's a journey, and it takes patience, persistence, and realistic expectations.
It does. It's a marathon, not a sprint.
And then there's the idea that Forex is too complex, only for people with fancy math or finance degrees.
Another myth. Forex does have a learning curve, but anyone can learn it.
With the right resources and some guidance, anyone can understand the basics and start developing their skills.
That's what we've tried to do in this deep dive, make Forex more approachable, give you that foundation, and encourage you to start your own journey.
And we've only just scratched the surface. There's a whole world out there to explore, so much to learn, opportunities to grow, and yes, potentially profit.
Remember, the journey of 1,000 pips begins with a single step.
So true. And on that note, we've reached the end of our Forex deep dive. We hope you've enjoyed the journey and found it helpful.
We've covered so much, from those basic building blocks to the more advanced stuff, and we hope you feel ready to take on the market.
But this is just the beginning. Stay curious, stay disciplined, never stop learning.
Trade responsibly, manage your risk, and always keep your goals in sight.
Thanks for joining us on this deep dive. We wish you all the best on your trading journey.